Hello and welcome to Sprott Radio. I'm your host, Ed Coyne, Senior Managing Partner at Sprott Asset Management. I'm pleased today to welcome a new and special guest, Carter Worth, CEO and founder of Worth Charting, LLC. Carter joins us today with over 30 years of technical analysis. Carter, thank you for joining Sprott Radio.
Thank you so much.
Well, Carter, before we dive into the world of trying to understand the markets through technical analysis, I thought it'd be helpful for our listeners to hear a bit about yourself and your background and what got you into this part of the markets.
Sure. Well, just to start with, just in finance in general, I have no natural God-given talents to speak of. If I could, after all, swing the golf club like Tiger Woods, I would have done that. If I could sing like Mick Jagger and the Rolling Stones, I would have done that. If I could act like Tom Hanks, I would have done that. But I did grow up in Manhattan, New York City, and the cottage industry here is finance. And I looked around, and you have a circumstance where even very mediocre people can make outsized income. And so I went to Wall Street. But I started out as a fundamental analyst, and in fairly short order, after about two and a half years of that, I call it the fundamentals, I started to, because of one man who showed me a few things. He had started in the Fidelity chart room in the 1960s. He was a lawyer by training, but it basically, on the spot, struck me as something that I needed to pursue. And so I put away all my Q's and K's, and I dedicated myself to the study of price action, which is what technical analysis is. And we can go into that a little more if that's helpful or productive.
You said something I thought that was pretty good, which is, fundamentals. There's a lot of charts out there that people will quote and look at that frankly don't really mean a whole lot. So maybe let's start at the beginning and talk about the price action, why that's important, and some of the other trends you like to look for and why those are relevant.
Perfect. So it really gets down to this. One either accepts or does not accept the concept that there is wisdom in price. Now, on its face, it's controversial, and it always was. The original technicians, no one believed them. Interestingly, they had to name these patterns to try to get the sort of layperson or sort of a colleague to see. And it's not about whether you call it a head and shoulders or cup and handle or rounding bottom. These patterns, they repeat. And what it's about when I say there's wisdom in price, that look, the Federal Reserve includes in its leading indicator index stock prices. They know this. And so what I would characterize it is basically this thing which is now embraced is that there's the wisdom of the crowd. Now, Aristotle was credited with the first person to introduce that concept in his work, Politics. But it's counterintuitive. The ego, the individual, my own, right, wants to think that, but I was the valedictorian, top in my class, maybe at McGill, for instance. Then I went to Harvard Business School, and I work at Goldman Sachs or wherever, and I can outsmart everyone and figure out the answer. And we all have it. That's what a good, healthy ego would be, or relying on an expert's insight. But what it turns out, in fact, that a group of individuals, a broad group, is almost invariably and always smarter than an individual, even if it's an expert. And so that is the concept of wisdom of crowds. But let's use some very pedestrian examples to make that point. There's been studies, and you can go on the internet and see some in the early 1900s, where you would be at a county fair, a simple thing, and you would have asked people, how much does this heifer weigh, the cow? And, there's a cow up on a platform. This is 100 plus years ago. And they do this in business school now. You can go online. There's a recent picture of a cow, and people had to guess how much does it weigh. But people's guess is, oh, that's a 400-pound cow. Oh, way, that's a 1,200-pound cow. Well, what happens when you take the average guess, it's within like 50, 60 pounds every time, an animal that's about 1,200 pounds. So while the individual guesses are all over the place, quite inaccurate, the collective group is very accurate. And so that's what charts are. And so when I make recommendations, and this one can say this is insane or remarkable, or a little bit of both. Look, just having done this for 32 years, speaking to almost every single large mutual fund complex there is, the portfolio manager there, every endowment, family office, state pension plans. And the point is, I make recommendations. I don't know whether the company in question does sushi or sneakers or soda water. I'm just studying price. It's not unique. There are a lot of other chartists out there, but I have been doing it a long time. And so this concept is slowly been embraced. And now, of course, it's everywhere. The major hedge funds all have quant teams. They study price aggressively. And we all in our day use this. We don't turn to food critics anymore. For a restaurant review, we look at the group review from how many people have gone there. And so this concept is proved now at this point. And the chart is a pictorial representation of price. And maybe I'll stop there, but the key elements are studying basically not only price, but volume, the level of turnover. Unusual volume is the tell. If a stock trades 1 million shares a day, 1 million shares the next day, 1 million shares, and one day it's only 10:30, 11, it's already traded 800,000. And then at noon, it's already traded 3 million. And then by the close, it's traded 4.5. How could there be a fourfold increase in volume? One could say, well, maybe there was an upgrade on Wall Street, but there wasn't. Or maybe there's an article in the New York Times or Wall Street Journal Barron's, but there wasn't. It's all about the volume. So maybe I'll end here. The existentialists that Camus and the Sartre would argue and did that existence precedes essence. And in markets, volume precedes price. It's not studying companies, it's studying the price action.
And do you ever care about the why?
Never. I'm not, that's just it. I'm not in the why business. I'm in the what business. Not at all. Let's take, the S&P 500 has 500 stocks. The average is covered by 20 analysts. That's 10,000 ratings. Do you know how many are sell rated? 5%. It's never changed. How can that be? Because Wall Street has this hole, which is a euphemism for sell, right? And if you look on any, you'll see half the analysts have a price target 12 months hence that's below the current price. Well, if you think the stock's going to be down in the next 12 months, why would you have it as a hold? Because they don't want to offend the IR department. Then they won't get invited on the junket, the golf trip. They won't get, and so it's all a bit of a game, right? If no one says sell, that's why they call it the sell side after all. They all want you to buy. And there's a lot of it that's not very serious. And I was a part of that, and that's why I got away from it.
One of the things you hear a lot in the world of technical analysis is the word breakout.
Yep.
What does that actually mean when someone's looking at a chart and it breaks out?
In the stock market or currency market or commodity market, it's typically a stock, security of any kind that's been toying with the prospect of moving above well-defined intermediate highs and 52-week highs. So it's been range-bound but strong, but can't seem to get out of the range that it's been in. And then a stock, a currency commodity will quite often, news-related, more often not, break out, start to move up and out of that range. And that is a very robust factor or moment in terms of committing capital. There are false breakouts, of course, but over time, breakouts are very, very efficacious in terms of entry points.
And as it relates to charts, what are some of your, either your favorite charts or your favorite moves within a chart? What are the things that really stand out at you that you get, if it's possible to get excited about them? What do you get excited about when you look at these things?
Yeah, exactly. Inflection points is what we're looking for, right? And there's, you're looking for several inflection points, but a great one is a breakout. So consider it in the mind's eye, something that's been range bound and lackluster without any character, meandering, that then comes to life and moves up and out of the range. That is one. Another is characterized as a bearish to bullish reversal. A stock that's been in an established downtrend, weak and unrelenting, that then starts to stop going down, starts to actually base and bottom and cure and heal, and then starts to come to life. Now, that's more what value investing is, finding something that's quite distressed, that's not going out of business, that makes the turn. So those are two very interesting inflection points.
I'm sure you see this all the time in talking with your clients, your subscribers. I'm sure you see different people coming to different types of decisions based off the exact same chart they're looking at. And I'm not just talking about long versus short, just general decisions. Walk us through that a little bit, because that must be fun for you to watch that kind of crash unfold.
You can, just as you can pull up any stock, Royal Bank of Canada or Caterpillar Tractor or Dollarama, and you'll find, wow, this firm has it as a sell rating. This firm has it as a buy rating. There's always difference of opinion, whether one comes at it from a fundamental point of view or a technical point of view or a quantitative point of view. But more often than not, there's a clustering of opinion in terms of technicals and studying price action of what something is likely to do. And so while there are divergent or outlier views from time to time. Good technique and methodology typically ends up in the same spot.
And what about a sector or industry? Any particular areas that you tend to focus on more than others? Are you looking at purely price across the universe?
Everything, right? And so the idea is to try to be right about one stock and then another stock, and then to make inferences about groupings. If we can notice that several home builders are acting well, then we can make a judgment about home builders as a group. Or one could then make a judgment about home builders and autos individually and say, well, we can make a judgment about a bigger group, which is consumer discretionary, or a bigger group still, the market. The market is just a group of individual constituents. So the idea is to be right about the parts in order to study the whole.
And are there any current, sectors or industries or themes right now that are really kind of glaring? You can't open the paper or turn on the TV without hearing the word AI right now. But what else out there is sort of getting your attention right now based off price action, based off trends and so forth?
Sure. Well, that's certainly one of them. The very steep and uncorrected nature of the move in technology and communication stocks. And we are now in the process of correcting the very steep, uncorrected 6-month advance that we've seen since the October low. Right, S&P advanced 28%, the QQQ 32, the semiconductor index almost 60. And so when you do get an outside move like that, the normal sequencing calls for some sort of give back, whether you call it a drop, a decline, a dip, a correction, a sell-off. In the study of sequences, when you're in a good and established uptrend, you have counter-trend moves, which are sell-offs. Just as when you're in a downtrend, you have counter-trend moves, which are rallies. The most interesting thing here from my seat is, again, to be continually and to add to short exposure or underweight this very extended, loved area of the market, which is technology and all things related. And then gold, of course, is fantastic, and gold miners as well on the long side.
So gold is fantastic. You're one of a few people that I hear say that these days. And this is what we do. I mean, anyone that's listening to Sprott knows that we are a precious metals and critical material firm. But is it fantastic because of the price moves we've seen recently? Walk us through that a little bit. Why do you say that?
Well, so gold is a perfect example of what you're talking of a breakout, right? Gold was range bound for almost 4 years, just doing absolutely nothing. And we broke out of that range just 6-8 weeks ago. So if one were to, you could picture it in the mind's eye, gold bullion was where it was just 2 weeks ago, as far back as 2020. So during COVID, right, gold reached a high of $2,075 an ounce in August of 2020. And then all the way until March of 2024, it was the exact same level. And then we have broken out in a big way and gone from 2075 to 2400. So it's a textbook example, a prototypical example, something range bound that continues to try to get out of that range, and then it does, breaks out. And a bit esoteric, but there's something known as a measured move to try to project how high anything will go having broken out from a range. And a measured move calls for about 2550. So we're just sticking with that price objective published in the beginning of the year.
Well, that brings up another question, sustainability of those moves, that measured move. There's a lot of things like that. I mean, copper right now is being talked a lot about. Uranium is being talked a lot about. It had a big move, and now it sort of seems to have settled in a little bit, potentially for another move higher, who knows? When you look at things like that, a pure commodity, a pure metal, where it doesn't have as much price action per se because it's not a traditional business in the S&P that has a ton of analysts. Does that mean anything, or is it purely, again, going back to simply this price?
It's just back to every day there's a high, there's a low, there's a close, and you have the trading range on the day. So the pattern, again, is the same. And for instance, gold, right? I mean, we know that gold, there's a bit of worry here that somehow it's dipped or it's not doing well. Gold went from $1,800 an ounce. I mean, the lows were October of 2023. And that's up $625 an ounce. And so the way I would characterize it is, having advanced to that extent, gold is entitled to pull back, right? So you're talking about a 35% move, $1,800 an ounce in October of 2023 to $2,400 an ounce in April of 2024. And now it's pulled back all of, 5%? It's nothing. And it's actually healthy because the steeper and further you go without a correction, right, you get exhausted. So think about any endeavor in the gym. If you push it too hard, which allows you to take a break, you rest, and then you can go again. If you don't ever take a break, you have a coronary. In the library, if you just keep studying and studying, you burn your eyes out. But if you walk around the block, go get some coffee, then you can go back and study again. It's the dips, it's the counter trends that allow something that's in an uptrend to then reassert itself and continue higher.
And how about a lens? How wide of a lens will you look at? Will you look at it over the last 2 to 3 years? Will you ever look at things over decades and see what the long-term trends are? What do you like to focus on?
All time frames. I mean, so for instance, we know that gold is nowhere near its all-time high adjusted for inflation, right? That high in 1980, gold would have to go up 50% from here to return to its inflation adjusted, or in real terms, high of 1980. Silver would have to go up 6-fold to do that. And silver, of course, is nowhere near its own high and of the Hunt brothers peak, right, when they cornered the market, and then the double top in 2011. I think they're excellent here, and I look at all time frames.
Well, 32 years of experience in doing this in some way, shape, or form, could you share a couple kind of aha moments or highlights that you've seen where a chart that you almost want to mat it and frame it and put it on your wall and say this was a unique moment in time? Do you have any of those? Like The Big Short, everybody saw that movie, or most people saw that movie. Any experiences like that in the 32 years that you can look back on and be like, how did not everybody see this?
For me, two that stand out. One would be the sell-off in the financial crisis in 2008 and 2009. Starting in the autumn of 2008, we know the market actually bottoms in March of 2009. But if you look at the structural low for the market was actually in November of 2008. In fact, the peak in the VIX was in October of 2008, not in the 2009 low. And the number of stocks making new 52-week lows at the 2009 low was actually contracting because many stocks had already started to turn. And so we look for divergences like that to try to make a judgment that this is actually ending, even though there might be sort of an afterthought incremental low. The structure of the market starts to improve before the market. And you'll see that in a top. For instance, in the dot-com peak, while there is a day in time, March 24th, I guess, is 2000, many individual stocks had already turned down. So an aggregation will always be slow. The way to study an index is not to study the index, it's to study the parts, right? The parts compose the whole. So a weak form of analysis is studying indexes. The strong form is studying the constituents. That is a concept. We've used that, and I learned that from my teacher and mentor, to try to be there for big inflection points. The way I would, again, always try to use examples, if you walked into the doctor and just had him look at you from across the room, he seems, but he doesn't know, do you have gout or high blood pressure or diabetes? You got to get under the hood. This is elemental, right? And so index work is a weak form. The way to study an index and come to a judgment is to study its parts. The parts compose the whole comprises the parts.
Well, Carter, this has been really fascinating. Every once in a while I get on some of these podcasts and really learn a hell of a lot more than I thought I was going to learn. So this has been really great. For our listeners that would like to follow you and potentially subscribe to you, how can someone track you down and find you?
Sure. So we have an institutional business, which is, as discussed, that's a traditional Wall Street, no different than any other sell-side firm. And then we have a subscription service for individuals, and it's at worthcharting.com. And this is something we would certainly invite you to have a look.
Well, Carter, again, thank you for taking the time, making the time today, really, to speak with us. I learned a lot. I'm hopefully a lot of our listeners are going to walk away with this as well and start looking at the markets maybe a little differently than they have in the past. So thanks again for spending some time with us today on Sprott Radio.
Well, thank you much for having me.
And once again, my name's Ed Coyne, and you're listening to Sprott Radio.
This podcast is provided for information purposes only from sources believed to be reliable. However, Sprott does not warrant its completeness or accuracy. Any opinions and estimates constitute our judgment as of the date of this material and are subject to change without notice. past performance is not indicative of future results. This communication is not intended as an offer or solicitation for the purchase or sale of any financial instrument. Any opinions and recommendations herein do not take into account individual client circumstances, objectives, or needs, and are not intended as recommendations of particular securities, financial instruments, or strategies. You must make your own independent decisions regarding any securities, financial instruments, or strategies mentioned or related to the information herein. This communication may not be redistributed or retransmitted in whole or in part or in any form or manner without the express written consent of Sprott. Any unauthorized use or disclosure is prohibited. Receipt and review of this information constitutes your agreement not to redistribute or retransmit the contents and information contained in this communication without first obtaining express permission from an authorized officer of Sprott.